Hello folks, this is Michael with a warm welcome to part 5 in our continuing series of the ICT Scout Sniper Basic Field Guide. And this episode is titled Range Finding. Okay, and what will we be covering in this presentation? Well, we're going to be reviewing the previous episode's assignment, Tracking Institutional Price Action. Now, you were instructed to go through your charts and look at the daily and 4-hour and look for reference points and order blocks so you can pull your fibs across hunting optimal trade entries. For those that didn't do the homework, we're going to be giving a couple examples, and we're going to be looking at specific charts, and we're going to give specific order block illustrations. Now, I worked up a couple illustrations, obviously in the fiber, which is the Euro USD. We give you a bullish example. In fact, we're going to probably give you 2 or 3 of them. And we're going to give you a bearish example. And we're going to be looking at a pair that's probably very alien to anyone that's been following my work, the Canadian dollar and Japanese yen pair. Okay, we're going to be looking at a bullish example of that. Basically, to highlight the overall universal application to my concepts, even applying it to an exotic pair like this as an illustration. And we're looking at another, in my opinion, is an exotic, is Australian and Japanese yen. We're going to give you a bullish example as that pair illustrates an exotic application as well. We're going to be talking about target selection concepts, and it begins with price swings. And now obviously it's in the eye of the beholder. Okay, so without your ability to see the overall price swings, that's going to be the hindering or obstacle for you. Okay, so you're going to have to put some time into looking at the charts. If you haven't already done so and acquired that talent, you're going to need to do that before you can actually move forward. Price reference points, we're going to be talking about that specifically. And we're going to be introducing the 50% rule of symmetrical price swings, and we're going to be giving you the instructions of MT4 fib calibration. And we're going to be looking at ICT swing projections. Wow. Market symmetry in the bullish realm. Okay, we're going to be talking about equilibrium and price swing fulcrums. We're going to give you upside objectives. And we're going to be looking at the chart examples of upside swing projections. And we're going to be giving you a bearish market symmetry, dealing with the equilibrium and price swing fulcrums, which points to downside objectives. And we're going to give you examples of downside price projections as well. And yes, homework. We're going to be looking at projecting swing targets. So let's get started. Okay guys, we're looking at the euro. This is the daily chart on the fiber. And I'm going to draw a few things here I'm going to bring your attention to. We have this high here and this high here. And we're going to put it right on the highest high of this candle. It's roughly 34.50. But I want to draw your attention to the bodies of these candles and the highs of these. Okay, if we draw our little horizontal line down to that, and we're just going to move around. There you go. You see that? 34.20. 34.20 is the level essentially that this price was reaching for. Okay, because it's the institutional level we like to follow. Again, it's the full figures, 00 levels, the 20s, the 50s, mid figures, and the 80s. Okay, so we have this level here, 34.20. So remember that because we're going to come back to it in a few moments. But this is what price action was doing prior to the previous release of episode 4 in this series. And what we're going to do is we're going to draw our chart into a 4-hour basis. And again, that 134.20 level, keep that in mind. Okay, we have the 4-hour chart here. We have market structure breaking here, breaking this high here, coming back down, trading into this previous order block. Okay, and we're going to put a few different order blocks on this chart. Okay, price dips into it right in here. And we also have market structure breaking and confirming even further here with another order block here that we will reference. Okay, so again we have this block and this block, and I'm going to just change the color of this one just so it could be slightly different, or in this case drastically different. So we have market structure again, shifted bullish here. The low was maintained here, made a higher high here. So this low is sensitive. In other words, we want to see price, and anticipate rather, price staying above this low. Okay, but let's pull our fib across these ranges. Okay, we have the low to high, and price coming down to the 79-cent retracement level, that 134.76 level. So really the 134.80 is a real handsome area that one could utilize to get long. The fiber really likes the 80s to 20s and 50s, and price did obviously give you an opportunity to be a buyer here. But moving forward, okay, that's where we're at now. We're going to look at examples, okay, based on the idea what we shared in part 4. Okay, this was the order block that would have been staring you in the face at the time of the last release of part 4 of ICT's Scout Sniper Field Training Guide. Price comes right down. Here is the day that the market, the video was released, right in here, and this is where, if you look at the swing here, here's the price swing, and you have the 79-cent retracement level right in here. Okay, and price trades down. It gives you a nice hammer. See that? It's a very nice confirmation in terms of candlestick patterns. Okay, just candlestick pattern alone means nothing, but when you have this coupled with an order block, it dips into it right here. And I guess it'd be a little bit more helpful if I drew that over here for you to illustrate what specifically I'm referring to. And also, let's go back to that 134.20 level. Okay, I'm just going to squeeze this chart out just a little bit because we need to reference a level that's outside of the view. Okay, here's that 134.20 level. All right, and again, we're referencing this old high. Okay, so let's go back to that chart, and we're going to use our fib from that level up to this price point right there. Okay, so we have the 62% retracement level coming in around that 134.74 level. Okay, so by itself, between here and here, this is an area where we could reasonably expect to see price bounce if we're using that range. Okay, and the 134.50 level here, let's draw our fib from that reference point. And we have price moving within the optimal trade entry, trading right down to that sweet spot. I don't know why I keep doing that with the mouse. Price trades up. Okay, and so we have one optimal trade entry in here. Price rallies up. We have another order block right in here. So I'm just going to borrow this range. Okay, and if price dips down into that, we could be a buyer again. Okay, again, this is a 4-hour chart. Okay, so 134.94, 135.08, the range in between here is a nice level to anticipate a possible buying opportunity should price get back down into this order block and the fibs. Price trades right down to that 62% retracement level right in here. I like these two candles like that. It's nice as tweezers. Price comes right down again, dips right down to that 134.20 135, almost a 135 figure, big figure, and rallies up aggressively. And you can see we moved up pretty handsomely. Okay, so you have a few opportunities in here where it was obvious that the higher prices that we were calling, these are the setups that were available to you, and ultimately price did trade lower here. We broke a significant low, and let's look at that for a moment, because I was asked in Twitter to give an example of a bearish environment where you could use this information. So we have the bullish candle prior to the move down. Okay, inside of this area here, okay, this big candle, institutions were selling into that. Okay, and market rally, declined. And what you want to do is you want to see price try to trade right back up into that level, into that order block. And let's use our price points. 136.20 institutional, which is essentially in the area of this candle. We could use 136 figure, but it's very close to the level here, so I want to be outside of the range with the expectation that this this market may in fact roll over. Okay, I'm using the lowest low here, okay, prior to that 136.20. So the range is between this low and the institutional level, which is essentially where this is keying off of. And if price gets up into these levels here, we could be a seller. And you see that happening right there. Okay. Notice that we dipped above this level. So we went back inside of the order block here, and we had a nice optimal trade entry. Boom. Okay. If you want to go to the basic OTE, you can use this swing high and this swing high. Okay, but I'm going to show you the highest high down to that low. Okay, we got just the equilibrium point, okay, which really isn't beneficial to me. If we use this swing high here, you bang up into that 62% retracement level and still inside the order block. But notice the candles were unable to have any of their bodies within that realm. It's only the wicks, and then it was rejected and traded off. Then we had obviously another retracement. Let's get the fib off. Okay, we have an order block here. Okay, price slipped lower. If trades back up into this area or a little bit higher, we could look for a sell. And price gives you an opportunity to trades right in here. But where does it go? Right back into an old order block, sent it higher here. And this is where we're trading at now. Okay. So again, that's the fiber. And if you go back out, and we're going to look at this particular order block here, and this occurred on the 30th, so the day of the release of the episode 4. Okay, this broke out, started moving higher, and price moving back into this order block here would be indicative of a buy opportunity. So we're going to look at how price dipped into it here on the 2nd of October. And we're going to just take this little thing here and drop it right on there. And it should, when we go down to a 5-minute chart, should drop us into the New York session. Voila, there we go. So price drops down into it here, right there, and you get that explosive rally up. Do you think institutions were behind that move? Or do you think it was Joe Public? Clearly, institutions. Okay, and then obviously you can see how price rolled on higher. And the exercises that you were instructed to do were to utilize these concepts and move forward, and you judge whether or not they're useful to you. I can assure you, if you spend some time with it, you're going to find that it's hard pressed to find something that's more accurate than what's being shared in this video series, because it doesn't exist anywhere else. And if I didn't make money with it, I could sell the concepts and try to, build a service system around it. But I'm not interested in doing that. I make a lot more money actually utilizing it. So it's obviously something that you can learn on your own. And it's not just this pair, okay? It's not just the cable, okay, British Pound USD. Not the pairs that ICT likes. It's universal. And because it is universal, you can use it in other pairs. And we're going to take a look at that now with two of the weirdest pairs in the ICT repertoire. But we're going to be taking a look at the Canadian dollar and Japanese yen. I know you're scratching your head thinking, what is that? And then the Australian Japanese yen. Okay, so let's take a look at those now. Okay, folks, we're looking at a pair that I never trade, but I just want to give you these examples to kind of frame the universal application of these concepts and really communicate that it's not limited just to the fiber and cable, which is predominantly my pet pairs in the Forex market. I like to stay within the majors, but if you are just really one of those types of traders where you just have to be trading these exotic pairs, well, it still works, but I just simply don't trade it myself. Okay, so we're going to look at this example. It's the 4-hour chart on the Canadian dollar and Japanese yen pair, and I generally don't like to trade yen pairs, but again, just to illustrate the effectiveness of the tools, I want to draw your attention to the fact that we had this nice rally up. Okay, we had this really rapid increase in price, about 500 pips or more between the low here in August to the high formed late in September. And I want to draw your attention to the fact that we had a few areas of where price could reasonably expect to see a bounce. You see this consolidation in here, and we had a consolidation here as well. Notice they are accumulating around old highs and lows here to the left side of your chart. Let me draw your attention specifically to this one right here. Okay, this is a down candle within this consolidation prior to the move out of this consolidation. In other words, we're going to be using the high of that candle as the beginning point of where a institutional order block may reside. Okay, and there's a few things that we could be utilizing in this setup. We could be referring to this swing low here prior to this rally up. Okay, and we're going to use the highest high, which is this one right here. Okay, notice we have a 62% optimal trade entry overlay right here. Okay, you see how that's very close to proximity of that 94.60. We got 94.65, so it's only a variance of 5 pips. Nothing wrong with that. Okay, so anywhere between the 94.65, 94.60, maybe even 55 level to allow for some slippage, to allow those orders to be pinged. We could see a nice little bounce in here. Okay, and another area where we have consolidation, which is in here. Okay, prior to the rally up out of that consolidation, The down candle prior to the move is right in here. Okay, so we're going to use the high of that candle right in there. Okay, and if price trades lower and much deeper into that price swing, okay, we could use this low to this high, because we're looking at the range between the low here and the high here, much in the same way we did this low to this high. Okay, notice we have the 79-cent retracement level laying right on that same order block. Okay, so if the optimal trade entry sees price come trade down into these levels here, that could be a favorable area to be anticipating a bounce as well. Now again, all these levels do are highlight areas where on the smaller time frame price entry patterns formulate, okay, or come to fruition. And since we're teaching the optimal trade entry, which is the retracement inside of a price swing between the 62 and 79-cent retracement level, we would like to see a price pattern in the same capacity in a fractal nature on a smaller time frame, i.e. 5-minute, 15-minute. Okay, so with that said, let's take a look at what transpired. Okay, the first one we're going to look at is here and here, the second one. Okay, and as price moved along, notice how price came right down to that level right there. Okay, and bounced up. Just in that little bounce right there, we're looking at a potential for price move of 100 pips. Okay, I don't know if you can see that. The middle number here, it's 100 pips. Nothing wrong with that. Okay, and that's intraday. Again, each one of these candles represents a 4-hour time period. Okay, price invariably goes lower, trades in the direction of the higher time frame retracement. Okay, and as price moves around, comes back up, finds some resistance to that same level twice, and then moves down to what level? That 93.37. Okay, 93.37. So we came right back down to this point of origin where this initial price move originated. Okay, price comes down, stabs through it, pinging any orders that would have been around that 93.35 to 93.40 level. Okay, and price proceeds to move up into present market. If you look at where we moved from this level here up to the high, now again, this is the best case scenario. That's 180 plus pips. Okay, just trading that bounce right here. Now what we're going to do is we're going to break that down and zoom in into both of those areas to highlight where price may have, because we don't know, I'm looking at these examples for the first time, so I may be encountered with an opportunity that wasn't there. Okay, but for now we're just going to take a look at this here. And when price trades down into these levels here, we want to be looking for an optimal trade entry to key off of on a lower time frame. Okay, so we're going to do that now. Okay, we're zoomed in on the Canadian dollar Japanese yen pair. This is a 5-minute chart. This is the first of the higher most price levels that we were looking at on the 4-hour chart. And this is the day that the last video of this series was recorded and posted on YouTube. This is September 30th. And we're moving down inside of this 4-hour order block, delineated with this blue level in here. Okay, and when we look for specific price patterns, okay, there's a couple things we got to go back to. Remember, we're in the 5th part of the series, but it's not that you're supposed to forget everything we learned and covered in the previous videos. We're going to now go back throughout the first 4 videos and pull out some of the gems that you should have been gleaning and keeping track of on your little notepad, and hopefully you can start seeing these things start synergizing. Okay, when we see an order block like this, okay, much like in a higher level time frame key support resistance level, we are to calibrate them. Okay, this level here, that 94.60, is already calibrated to a small round number, but now think in terms of big round numbers. Okay, we have the 94.80 level institutional up here. Okay, so that's one level that can be considered. Okay, what we're going to do is we're going to draw a line on that. so that may be one of interest. And we have one here that's just a little bit outside of the candle, but you still have to consider it because of static alone. Okay, just the normal volatility in the marketplace. If it goes to 94.60, okay, and the order block dips below that, chances are it could utilize the 94.50 level, the big figure halfway part. In other words, it's a mid figure. So what we're going to do is we're going to have our chart, and I'm going to highlight that level here. Okay, now if you refer back to the previous videos, okay, you're going to remember this term, hidden optimal trade entry. Okay, remember, support and resistance, if it's good, it won't go down to the level twice. Okay, in other words, it will be accumulated and then it won't go back and dip down further. That's the premise between optimal trade entry. Well, sometimes we don't necessarily have a specific price action. In other words, there's a gap between the 50 level and where price is trading in here. Okay, now remember, gaps don't always have to be filled, and that notion is one of the central tenets to this pattern, and this is one of the applications you can utilize for. So what we're going to do is we're going to have our Fibonacci tool, okay, and our point of reference here is this is the highest high at the time, okay, going into this order block, and we're going to reference this 94.50 level, okay, and you pull this up, and what you're looking for is you're going to drop it right on the highest high like that. So you anchored your 100 level to the 94.50 mid figure point, okay, and that's going to give you a range between the mid figure and the highest high in here. Okay, now if price is accumulating in here, now you are not going to see this Fibonacci tool application anywhere else. This is completely and utterly unique to me. Okay, now I catch a lot of flack for this thing, but I also catch a whole lot of incredible entry points, and I have trades that support it and results that reflect it. So the bottom line is it's going to take a knack for you to learn to trust this. Okay, and the only way you do it is if you play around with it and you do your own research on this pattern. Okay, but it's still an optimal trade entry. It's a retracement within a range. Now it's price has not traded down to this point yet. Okay, but because there's psychological barriers, okay, in price, we have to consider it. Okay, and the way I use it is like this. Okay, so if price trades down to the 94.74 level, 94.69, or 94.63, that would constitute an optimal trade entry, okay, within the order block, with the understanding and premise that it may not get down to 94.60 or to 94.50, okay, or very well may just trade through it and spike even lower and not even give me a pattern at all. Okay, but we have to consider this is a range. Even though price has not traded to it as of yet, or if at all, we still consider that because it's a probable range within where price may have a bounce. Okay, and I'll give you more examples in this series, but for now, let's just work with this one. And as price moves down into this level, okay, price goes just a little bit through the 79% retracement level, doesn't get to the 94.60 here. Price begins to rally off and takes off. Okay, and there is approximately 100 pips in price swing right in here. Okay, so you're finding the range where price may produce a move of sorts, but it's going to elude you if you're just looking for simple things like this, like here's a low to this high, if price retraces down to a range between this low and this high. That's basic price retracements. This is higher class, different level type Fibonacci stuff. And again, I didn't learn it anywhere except for in the charts. Just referencing the mid levels, the 50 levels, the 100 levels. Okay, it's applicable with the institutional levels as well, but when it's traded like this application, I use really just the full figure and mid figure levels. Okay, because if the order block is like this and it's around that 50 level, I'm going to be hunting a setup similar to this. Okay, this is again a pair I don't trade, but you can still utilize this this application on any pair of your choice. But again, because I know this is probably went over a lot of your heads, and I don't mean it to be you know, a braggart, but we're gonna go through the process one more time and explain what again I'm doing. Prices trading around into an area where an order block on a higher level time frame suggests that we may see a bounce. Okay, we are trading near a mid-figure level. Okay, and the range on the 4-hour order block suggests that price may dip down into at least that 94.55 level and below it. Now, if it's going to go there, it very well may go to the 94.50 level. It doesn't have to. Okay, in fact, I'd rather see it not do it. Okay, and that's what this pattern hinges on. Okay, so what we do is, again, once we anchor an area where we can clearly identify, and you could do a horizontal line here. I just used this because it's cleaner compared to the two lines we already had on the chart. But you just take your little crosshairs on the little marker here. You anchor it there. You pull it up to the highest high traded during that consolidation. Okay, and as price trades down into it, it'll reach into this range. Okay, and I know it sounds like voodoo. Okay, but I'm going to tell you right now, I've blown people away with this pattern over and over and over again. And once you identify how to use it, it's crazy. It's insane how very accurate it is. And it's nowhere in any books. It's nowhere in any video courses. I wish I could just simply say, hey, look, here's another reference source you can go to and study it. But it's really unique to ICT. So again, it's one of those things where, you know, whether you like it or don't like it, you know, the bottom line is I use it. It works. It's a pattern that I trade all the time. It's the hidden optimal trade entry, and it's based upon using support and resistance levels as your anchor points. Okay, not necessarily a key swing high or low, an anchor point referenced around price levels itself, that being the mid figure in this case or a big figure. Okay, so now let's move on and take a look at, okay, we are at the second of the 4-hour order block, potential areas on that Canadian Japanese yen pair. Okay, and we have this range here. We have the price bouncing off it initially, rallying up, and then starting to come back down. Now again, you could do a few things here. You could use your basic optimal trade entry, which is pulling a low to a high, and if price trades down to these levels in here, okay, 93.50 is a good area in here because it's around that big, mid-figure level. Okay, but draw your attention back to that 4-hour order block. Okay, this level here is 93.37. Okay, 93.37. Where is that in terms of institutional levels and big figures and mid figures? Okay, notice that we have the mid figure up here. Okay, so if I use that reference point, okay, we have that. Now if you draw the fib with that point like we just did on the previous example, this is what you arrive at. Okay, let me get that right where it belongs. Okay, so we're finding the range between the mid figure 93.50 and this high. Okay, so you have 93.66 and 93.59, which is essentially the 93.60 round number. Okay, which is, it's possible. It's possible you may see a little bounce in here. Okay, but is it near the order block? No. Okay, so I would reference really, let's take this fib off. Okay, you can go down to the 93.20 level. Okay, because there's your institutional level. Now we're going to use an application of the optimal trade entry based on the psychological level or institutional level. We like to use the 20 level. Okay, hidden optimal trade entry, again, using the range between that level. Again, we don't know if it's going to trade down to that level. In fact, we're hoping that it doesn't. But we have a range of 79-cent tracer level comes in at 93.36 with a range to 93.48. So anywhere in here, once we trade down to that level again, this is very handsome. I mean, in other words, an opportunity in here to be a buyer. Okay, between 93.48 and 93.35. Okay, if price trades right down into there, that would constitute enough for me to take a buy signal. Okay, price trades down, deviates to 79-cent tracer level just a little bit in here. Okay, and rallies on up. Finally breaks through the old market structure high in here. And you can see it trades on up to our previous levels we had noted on the earlier example, and then finally through it, and then today it's monkeying around finding support it. Let's go back to this point here, okay, because I want to show you how even if you were not using the institutional levels, okay, and you were going to reference, say, the big figure in this example, we're going to pull down to the 93 figure. Okay, and we're going to grab that 100 level and we're going to anchor it right to that. Now what we're doing is, again, we're looking at the range between the highest high here as it's dipping down into that order block. We don't expect it to get to 9300 because the order block's up here. Okay, but we also have price coming right down into, and it's a little difficult to see. Let me take this horizontal line off. We already know what that is anyway, so taking it off should not be a form of confusion for you. The price comes right into that 62% retracement level. Okay, it turns on a dime, and you get that same turn. So either or would have been applicable for you here, and it would have give you a dynamite entry point where you've really zeroed in much in the same way a sniper does with his scope. He zooms in and gets the kill shot here. Now again, assuming that you don't have this under your belt yet, okay, assuming you don't have that, and it's not something that you need to be ashamed of if you don't have it yet, because it's going to take a little time for you to trust this, okay. So again, you're going to have to do this on a daily basis. Go through your charts every single day. Do it on the 5-minute chart, 15-minute chart, hourly chart, and look at how price is trading around these big figures, institutional levels, okay, and you're looking for price within that range from those levels to where price is traded at its highest high and lowest low in the same examples that we just showed here. Now let's look at how price could be utilized. Let's get this fib off. I'm going to show you how you can use it here in the same capacity. We're going to highlight the 50 level here. Let's put that over here where I can see it. Okay, right in here. And notice how we have price rally up down here. If you take your fib again, anchor it right on that level, and you're going to pull it up to the highest high here. If price retraces down into that 79 to 62% retracement level, right in here, because we're moving out of the order block, this would be an opportunity for you to get in sync with the market move and catch, the underlying trend of the marketplace using that same premise. And the idea is we moved away from the 50 here, okay, and we made a high. Okay, we're above that big mid-figure level. Price should not come back down to that level, but we have a range between the 50 and the highest high here. As price dips down into that, right there's an opportunity to be a buyer and get in sync with the overall existing trend. Okay, you see that? Okay, we're looking at the Australian dollar and Japanese yen, continuing with the theme of looking at pairs that are outside of the ICT normal spectrum, okay, and considered an exotic pair, if you will. This trade in here is one I took on a live account You can see the results of that on Twitter, and you can find the link on the YouTube channel where it shows the results of it. And this price swing here, I tweeted asking everyone that were interested that if they would study this, you could see where we were moving back into an anticipated level of 4 hour, not 4 hour, potential order block, institutional. So as price moved lower, we traded right into that area right here. Okay, now we have this price swing here and retracement. So if you take the range from here, this low to this high, you can see price right here at the 79-cent retracement level, and we dipped right inside that existing order block. So we have a range between 91.23 and 91.27 in here. It's a little difficult to see. I'll move it a little bit. You can see that's the number it was at. So we're talking about an area in terms of 4 pips, okay, variance. So this point here and here, it's about 5 pips difference. So buying really at the 79-cent retracement level plus the spread, okay, we are still within very handsome. We're only talking about 14 pips, okay, so your trade should be allowing you at least 14 pips, movement, but that's for another video we're going to get to in terms of stop losses and such. But catching along in here, okay, price rallies on up, starts to move higher, okay, and then we have another area. Okay, just keep a reference point of this point here, right there, and probably make it bigger. Alright, so this is our reference point for the entry, okay, on a longer term price swing. So moving higher, we have another order block, okay, because we have a consolidation in here. Okay, we have this candle right there, this whole candle. So we're going to look at that area, okay, and we're going to reference this little segment in price, okay, and we're going to use the high end of it as our beginning point, and we're not going to buffer the lower end, but we're going to be very sensitive to that 91.58, which is essentially what level, guys? 91.60. Okay, so again, price maneuvers around a little bit, trades in continuously higher, trades right down into that level. Okay, see that? Slams right down into that. Now traders watching this that are not familiar with price action and institutional order flow and how prices move within specific defined ranges, they will be pretty much scared out of their mind. They would never even consider looking at that as a buying opportunity. Okay, but let's go back over and look at some of the essential tenets that we use in our concepts. We have a range low here to here. Okay, so we're trading with a fulfilled range premise in mind. Okay, so we have an area of 91.59 with a 91.58. Okay, so we have 1 pip variance. Do you think that's a confluence of support and resistance ideas suggested right there? Sure. Okay, so we could be a buyer right in here, okay, at that level, plus the spread in terms of if you want to be using a pending order for a limit. But let's reference, let's get that off, we don't need it. Let's reference our previous example, okay, where we used the support and resistance idea and Fibonacci concepts for hidden optimal trade entry. Okay, so we have price rallying up here, okay, and we have the 50 level, which is down here, and we have what institutional level below that? The 20. Okay, so we're going to look at 2 reference points there. So we're just going to be building upon our understanding of how to find the range. Okay, we have 91.20. and 91.50. Okay, so we're going to use our fib. We're going to start with the lowest one here, just to give you an idea, to the highest high prior to it. Okay, and you can see how the 62% retracement level calls for 91.55. Okay, so if you're buying with a 3 pips, sorry, not 3 pips, a 4 pip spread on the Aussie yen, you can get you long in here. If you were utilizing the 91.50 level, okay, they're calling for 91.63 as your 79% retracement level, and your sweet spot comes in at 91.68 in here. Okay, so anywhere in here would be a nice buy. And assume for a moment you use that one, and you're just looking for the sweet spot as your actual entry point. To this old low, we're looking at 23 pips. Okay, 23 pips risk, with the understanding and expectation that price should not go down to that point. If it does, it's probably not a good trade. You won't be confused if it does and stops you out though. Okay, so you understand that? If price goes to this low, the overall market structure that is implied here as being bullish isn't so bullish, then you'll probably see weaker prices. But in this case, we're building a premise that this is an area expected buying opportunity with the actual release in price here. Okay, again, public traders don't make price move like this. Okay, this is only going to be done by institutional traders, so they're going to drive it up like that. Price monkeys around, and again, this is a 15-minute time frame, so you can utilize a smaller 5-minute basis. Let's take this off. Okay, so you can have price bouncing here. If you drill down to a 5-minute chart, you can actually see that same event unfolding right here. Okay, with an optimal trade entry, which we're not going to go down to a 5-minute chart because, again, these videos are getting larger. By the time I'm done, I end up with a a huge. You can see it goes right down to that the 79% retracement level. Okay. Now, let's zoom in. I want to give you that as an example right in here. And this is that same little consolidation we just worked within. Let's use our reference point 91.50 again. Okay, and remember this is an unfulfilled range application. Okay, so we have the 50 level, put our fib on that, anchor it, pull it up to the highest high that we're seeing a retracement within. Okay, and then as price comes back down, 91.60 level plus the 4 pip spread, that would be an area to be a buyer, which would be up in here, and you can see price did in fact move up from there. Again, just giving you additional opportunities to see this in effect. And again, this is a smaller little, if you look at a 5-minute chart, you can actually see the order flow and order block in here. But this candle prior to the move up, it moved back into that same candle here prior to moving higher. Much in the same way it did here. We have this bearish candle prior to the move out. Go down to a 5-minute time frame, you can see how price moved back into that order block here and moved higher. Okay, and let's zoom out. Let's go back to our reference points of entry. We have this one here and this one here. Okay, and now we have another opportunity to see another optimal trade entry here using this range. So move this over so you can see a little bit clearer. Okay, we have the low here trading back down. Now as price moved off that larger order block level, price is starting to retrace. Would we expect it to come back down to there? Obviously, in an ideal world, we don't want to see that happening. So what do we have? We have a defined range. The range being this high noted here and the low right there, 91.58. Sorry, 91.56. I'm using the actual candle low. So we have a range between these two price points. As price rallies away from that order block level and it starts to retrace, we don't want to really see it come back down here. Can it? Sure it can. Okay, but ideally you want to be hunting a price pattern in here to get long with that premise in mind, looking for higher prices to ensue. And you see that happening here. Okay, again, same premise in mind. We have higher prices expected. We have an understanding of institutional order flow. We're going to hunt two opportunities in here. We have this level right here, 92.11. Price is rallying up. It starts to retrace. Okay, you're still overall bullish. So what are you going to be looking for? Retracing back down to 62 to 79 cent tracing level. You get that right here. Okay, and if you use our unfulfilled range concepts here, we expect price not to come back down to that institutional level. Price trades right to what level? The sweet spot. Boom, and rallies up. So both are ideally suggesting that's a buy area, anywhere between that 92.45 and 92.40 level. So add your spread to it, and that'd be an entry point, and then price begins to move on up. Even this this example here, we're going to look at here in a second. Get this stuff off the chart. We have another small, even again, this is a 15-minute chart, but if you go down to a 5-minute chart, you'll see this is another order block. Okay, so as price moves down into that level here, let's use our here's our low and our range high. Okay, so we have essentially a 100 pip move between the 2 points. If we use the low to high, price comes right down into that 62% retracement level, and what does it do? Returns back higher. Now ultimately, going into the weekend, we had a rather large weekend gap, but in here, just in here alone on Friday, and I'm talking about Friday prior to this recording, you have an opportunity to see a range in terms of pips of 54 pips, comfortably pulling out. Obviously 25 to 30 pips is not without the realm of possibility. Okay, so you can see just in one pair, and it's got to a 30-minute chart, you can see the overall price action, and actually goes down to a 15-minute chart, a little bit cleaner. There's the overall price structure, what's happened. Okay, and there was Friday's weekly high, and here's Monday's low on the week. Tuesday giving you opportunities to trade. And because this is a yen pair and it's an Aussie yen pair, it really will be looking to make its higher lows during the Asian session. Okay, and if you look at the Asian session on this week, we have this area here where price was making its low for Tuesday. And during the Asian session, the low on Wednesday was formed during the Asian session, and the low was formed on this this particular day. Comes in at the Asian session as well. Okay, so again, it's understanding your pair personalities and what characteristics go along with those particular pairs, and uh, what that animal does during the trading 24-hour period that we like to call the Forex day, because these are countries that are operating in their business around those times of the day. It's the beginning of their financial day, so it's important that they see particular market moves, and obviously signaling the significant highs and lows is one of the central characteristics to those pairs. Much in the same way we see the British pound and euro form its daily high or low on a daily range during the London session, because that's generally when they're coming online. Okay, so hopefully these examples have been useful to you. Go over them, study them, and then obviously use the same premise in studying your own charts on a live basis. And I promise you, put 2 to 3 months into start chart study using these concepts. You're going to start seeing there's a whole different world of price action that's available to you, and that's really found nowhere else. It's an ICT exclusive, and I hope it's been a blessing to you as it was for almost 2 decades for me. All right, guys. Every single Forex trader out there wants to see their trade become profitable. But before that can happen, you need to understand what it requires of you as a trader to learn to anticipate price moves. It's one thing to expect to make money, and it's altogether something else to expect to be accurate with your analysis. And one of the hardest things, and I mean this sincerely, one of the hardest things for me as a trader is the profit taking. Okay, because I've been doing this for almost 20 years, and my analysis concepts are very, very strong, but the human element behind them, sometimes I want to over trade the tools because of either a hunch or a gut feeling, and it's something that I have to suppress as a trader, because sometimes I think I'm smarter than my tools, and that's where my ego comes in. Okay, so I've had to really hammer out an application of when do I take profits. Now, early on, much like every other trader, if you go into this business and you encounter immediate profitability, whether it be short-term or intermediate term or long-term success in terms of duration, that's not the point. The point is if you go into it and you start making money, the premise is that you're always going to be making money, and your trades are therefore going to be profitable, and especially if you get these extrapolated profits, okay, really big targets, it kind of lulls you into thinking that that's the norm. Okay, and what will happen is many times if your tools suggest that it's going to be an 80 pip run up, you're going to hold for 80 pips or maybe even 82 or 83, trying to squeeze that last bit of juice out of that lemon. I have done that many a time, and I've watched my really good trades turn into mediocre trades, to break-even trades, and in the beginning of trading, I've actually watched them go into net losses, severely net losses. Okay, because much like anyone else, I was prone to the same pitfalls everyone else has encountered in their trading. And I didn't have any kind of mentors until Larry Williams. So I kind of like fumbled around in the markets until I got with someone that knew a little bit of technical analysis. I think everyone would agree that technical analysis and Larry Williams go hand in hand. So that was like my foundation. And I realized that I could be right on a lot of the market moves, but I would be wrong at my profitable exits, because I would be greedy and hold on to the absolute highest point. And it's my goal in this episode is really to communicate this as best I possibly can, is you do not need every piece of that move. Okay, you don't need every pip in every swing. You just need pips. Okay, and I don't want to really define it for anyone, but you just need pips. Okay, and I'll give you some ideas on how to frame that. What is your objective? Well, it depends on what type of trader you're going to be. This series is designed for getting that one shot, one kill for the week. Okay, that means you're really looking for a really cherry opportunity to be trading one time for the entire week. Okay, because if you can't do that, you're not going to be able to handle yourself trading every single day as a day trader, because you're going to be doing things, before you should. You're going to be buying more or selling more than you should. You're going to be doing everything wrong, okay, because you haven't developed the discipline that's necessary for you to be able to adhere to a set of rules. And yes, there are rules of engagement that you have to have as a trader. Okay, this whole trading series is themed around the military aspect, and I purposely chose that because that's what I had to do to myself. Because it's one thing for me to make these videos, and the majority of everyone out there thinks that I'm this cold calculated market wizard, okay, and I never make mistakes. I make mistakes, okay. My presentations are geared to you as a learning tool to avoid many of the things that I did early in my trading, and some of the things I still have to deal with on a daily basis as a trader. And that one particular thing is profits. If you do not have a predetermined exit point before you even get in the trade, I promise you, you will be plagued with this problem. And it may sound like a good problem to have, when to get out with profits, but I'm going to tell you, if you haven't been trading long, those of you who have been trading for a while know exactly what I'm talking about. Your winning trades, if you exit them and it continues to move 60, 70, 200 pips more than you got out at, are you right? Chances are you're going to define your trade as not right. Profitable, yes, but you're not right. So you're going to wrestle with that idea. Okay, you're going to argue with it, thinking, hey, I didn't do something right. I could have made a lot more pips. Instead of just saying, you know what? I saw an opportunity, I executed, I followed my plan, and I exited at a predetermined level. There should be no shame in that. Zero shame in it. But many of you will still arm wrestle yourself, beat yourself up, saying, man, I wish if I would have held on to that, that would have paid for the 16 losing trades I had the last 2 months. Look, you have to be disciplined. You absolutely have to have that in your repertoire, in your game plan, in your trading plan. You have to have it. Because if you don't have it, I can tell you, as almost a 2-decade veteran in trading, that is one of the most hardest things for traders to overcome. I can be wildly profitable, but I don't have it right every single time. And it's the times that I hold on for that 75 pip move when I'm already banked 60 pips in the first half of the trade, and I'm holding out for 75 for my second target, or my final collapsing of the open position. I may be seeing maybe the spread just before it gets me out, and I'll hold on to that thinking that I'm going to get that trade. Then it comes back and knocks me out, at 60 pips for the remaining portion. There's nothing wrong with that. But internally, I wrestle with that, thinking I should have just collapsed it when I, had 60 pips together. And now I'm arm wrestling myself internally. I'll be driving down the road, going to the store, going to the movies, or going to a red box to get a DVD for the night. And these things plague me, okay, because I have OCD. I completely understand obsessive compulsive disorder. I live it, okay. So if you don't have that, if you trade long enough, you might develop it, okay, because what will happen is you're going to overanalyze, like, everything you do. And that's a good thing as a learning tool, okay, but once you really adopt an idea of what you should be doing as a trading plan, you don't really want to overanalyze it. You want to stay within those parameters, okay? And that starts with, number one, having an idea of where you're going to get out at when the trade's moved in your favor, okay? That's not a limitation. Do not view exiting a trade at 60 pips profit, predetermined before you even put the trade on, and it moves 90 pips or 100 pips beyond that, okay? Do not view that as weakness, okay? Do not. Because I'm going to tell you right now, if you do that every single week or 3 times a month, you are in the upper 5% of Forex traders, because 90% of them don't make money. They aren't consistent. They can't even find the right time to get into trades, okay? And I don't mean that for some of you who are watching this. I'm not trying to beat you up or make you feel silly or uneducated, okay? I'm just trying to illustrate the point that you need to change your thought process about taking profits okay, before you even start implementing these tools. Because if you don't give yourself the permission to have a predetermined exit point and be content with that, you can slowly develop into bigger, longer term profit objectives, okay? But for now, let's just deal with this head on and understand that whatever profit opportunities you have predetermined in your trading plan, those are what you're sticking to. Come hell or high water, that's what you're going to do, okay? And then obviously you can tweak it later on that builds upon sound information and ideas and build a premise around. But until we get to that point, we have to have a foundation, and this is a very, very strong foundation. This is one of the things that I had to instill in my own trading, and it made a huge impact in my overall profitability and consistency. So now let's talk about price swings, because obviously without understanding what you're dealing with on a price level scale, you're not going to understand where profits should be taken. Now, if you're looking at this crude diagram, I agree, okay, but it's going to accomplish the method nonetheless. We have a small little minor price swing here. We have a intermediate term price swing and maybe even a longer term price swing, okay? Now, it's not really important as to what time frame this is because it's universal, it's applicable in all time frames. But we're going to say, for instance, that this is possibly a 5-minute chart, okay? And this is the beginning of a new day. You've hunted a setup, and maybe this is going into the London kill zone, and you've expected some level of support down here, okay? And you'll have to I have to apologize up ahead of this because I'm not going to be spending a whole lot of time dressing this up with a lot of lipstick as I did the previous ones, because quite frankly I am spending a lot of time on these videos, and even though you're getting the playback of about 2 hours and such, it's taking me about 9 hours to produce these things. So I'm trying to keep it short and sweet, even though it's not going to be that short and sweet on the viewing side of it. But assuming there's some kind of support level or premise that you think this is going to go higher, okay? We're not dealing with the entry points here, we're dealing with targeting. Assuming that you get in here on a minor pullback, okay, and something set up this opportunity as a buy, okay? And where do we anticipate the upside objectives? Okay, well, first you got to understand that there are price swings within price swings within price swings. Okay, this price swing here is about 50% of this range from high to low. This price swing here, okay, is equal to this price swing, but it retraces back within 50% range of this. Okay, so there's a rule here that you have to understand in targeting. That means a symmetrical price swing. Okay, a symmetrical price swing is basically something like this. This move up here, when this low, assuming this is a low, if it breaks right here, we should see an equal move from this low to this highest high. Okay, this becomes a fulcrum point, okay, or a pivot point. Not pivot point like S1, S2 type pivots. I'm talking about a pivot point in such a way where when price breaks that, you'll see it move lower. In other words, it's like a hinge right here. Price swung up. Once it broke that low, you should see an equal move from this low to this high in terms of range, equal from this low lower, and you see that here. Okay, that same thing can be developed on and moved into the degree once this high is broken, and you see that here. Now inside this price move here, assuming this is a price rally, it's a straight line, but obviously we know price isn't always moving in a straight line. There's other price swings within here, but the overall, what I'm trying to draw your eye to is this overall price swing lower. In this price swing from high to low, there may be 2, 3, maybe 4, even multiple smaller price swings within it prior to it turning and going up, to the targets you're hunting. This high, if it's broken, this is a fulcrum point on the bullish side. So as price rallies up, okay, and we're going to talk about multiple targeting and all that stuff in another video, but in here, as price breaks that point right here on this high, when it takes that out, we should see this move from this high to this low equal in terms of magnitude and distance and price. Add that to this high and you'll see it equal. So in other words, if you took a line here and measured it with a ruler of such, you should see basically the same distance from this high here to this low added to this high up, and you get this area here. That's the first fundamental premise to understanding how to take profits. Okay, now we're looking at a bullish scenario here, but if you cannot understand this, okay, it's going to be very difficult for you to understand where you should be taking profits. Okay, because if you understand this crude overall concept of price swings, okay, if you understand that, targeting and systematically taking it at predetermined levels is going to be very easy for you. If you cannot see that here, okay, it's going to be a little bit easier to see when I have it on charts, but it's paramount. You have to understand this because there is a 50% rule in symmetrical price action, and it's basically measured moves. This high to low, once broken here, you'll get a measured move higher. Okay, so let's take another closer look as to what I'm referring to. Okay, when you have a retracement, you have a price rally here, so this is an impulse move up. Then you have a retracement into this range from that low to high. This could be any number of things. This could be a higher level support line. It could be a pivot or a fib. Okay, it could be an order block. A lot of different things could substantiate this as a support level. But the main thing is you want to be looking at, obviously, when price moves beyond this level here, you want to see a equal move from this high to low added to this high's price point up. Okay, again, that's the same premise we just talked about on the previous slide, but now we're going to take it a little bit further. When you understand how to use Fibonacci, okay, Fibonacci, to get retracements, you would anchor the price point low here to this high. Okay, so those are your two reference points for retracements. On an up move, you're going to pull your fib from a low to a high, and what that'll do is it'll plot within the range of that low and high all of the retracement levels. So this may be a 50, this may be a 62, 79, such. So something down here would be an optimal trade entry. Now, as price moves up, once we take out this high, it does not guarantee that you'll get a 200% equal move from this high to this low. Once it's broken right here, there's no guarantee it's going to go 100% of whatever that range is. Okay, it's no guarantee of that. Okay, but there is a very large probability if you calculate the range from this high to this low. Let's assume for a moment that that's 100 pips. Okay, 100 pips. If price breaks that high, as it does here in this example, it's, again, obviously this is a hand-drawn illustration, it's not a price action chart, but as price blows out this high, when it does that, if you take the range from here to here, again, that being the 100 pips, assuming, if you see from the low here 127 pips up, price has a high probability of moving to that price point. Okay, if you go 162 pips from that low up here, 162 pips, you have a high probability of seeing that price move as well. Now, where did I get those numbers from? Some of you guys that understand Fibonacci are saying, well, that's pretty stupid. Obviously it's their 127 and 162 extensions. Right, but some of you aren't privy as to what I'm referring to, and we're going to learn that now. If you take your fib and reverse its application, okay, and I'm going to show you later on how to calibrate your MT4 Fibonacci tool. But if you take the fib and you anchor it from the high here and you draw it down to the low here, what that's going to do is it's going to plot a 1.27 and a 1.62 line. Okay, and when price blows out this high, when it reaches those levels, they are very, very, very good levels to take profits at. They're easily determined. They're predetermined. There's no ambiguity about it. You'll know exactly what you're looking for price-wise, and you can place your limit orders at those levels to get out at. Okay. But obviously, when we get to live examples in the charts, you'll see much more clearly what I'm referring to. Okay, let's assume for a moment that we're looking at a price move. It suggests this is going to go higher, and price has had an impulse move up, and now we're retracing within that range, the range being this low and this high. Something down here constitutes a order block maybe, or an optimal trade entry, something to support an idea that this is going to go higher, or assuming it's going to go higher. What will happen is you'll see, hopefully, price move in your favor, okay, and by pulling your fib from this level here to this level here, you can get your 127 and 162 extensions, and still anticipate, if you're in a higher time frame directional premise, you can anticipate a 200% price projection, okay, which is this high down to this low, that range, add that range to this high, and you'll get that high up here. Okay, that's the ultimate price level that you're looking for. That's about the furthest it's going to go. Now, will it go beyond that sometimes? Sure. Okay, many times it'll do that. But overall, if you look at 127, 162, and 200 as your extensions, they are ideal optimal exit points for your trades that are easily discernible, and there's no ambiguity whatsoever, because this wave lower is when it shoots higher. Okay, I probably shouldn't have said wave, because I don't want you guys thinking I'm an Elliott wave fan, because I am not. Okay, but this price swing, rather, when this price swing starts to complete move higher, we know that this market structure high, once it's broken out, we can have 127, 162, and 200 extensions predetermined based on this range here, with the premise that it's going higher off that retracement. Okay, as price moves lower into a deeper retracement of this impulse move, so we have this, again, this retracement lower within this range here, okay? It could go deeper, yes. Okay, it could retrace deeper, but we're just going to use this idea here as support and resistance. And with this likelihood of this being support, price could, again, move higher. And if we do assume that this is a buying opportunity, okay, maybe there's an order block over here and there's a consolidation within this leg up. Something constitutes a buy opportunity in here. If we buy here, we have a predetermined old high here, and in the range here, assume that's for the sake of argument, again, say it's 100 pips. We could take our anticipatory skills and expect to see price try to retest this high, and if it blows through that, we could reasonably expect to see the 127 or 127 pips from this low once it starts to turn up, or the 162 extension, which is 162 pips from that low. Okay, in this example, again, assuming that this is a 100 pip retracement. Obviously, your Fibonacci tool will give you all of the calculations, so I'm just giving it without the benefit of having a Fibonacci application on this diagram. So you'd be able to see when price takes this high out, 127 and 162 extensions respectively would be your upside objectives. Okay, so they're predetermined levels to exit at. Okay, so every time you trade within a price swing, you could derive it in advance where your exit points are going to be, know them beforehand, so you can use a limit order, and you can really pretty much go to sleep. Okay, you can go to work if you have your job. If it's the London session, if you can get yourself up out of the bed for a little while, set the orders up. Once you get into a trade, if for instance, let's assume that this is the London Open, and you're trying to be long, okay, you can put your limit orders here, okay, and go to bed, and hopefully sometime in London close or New York session, we could see those objectives fulfilled, okay, and that's just one application or anticipatory example. Okay, obviously the same thing could be said on the downside. Understanding if there is something up here that constitutes a selling opportunity, something bearish, okay, and we're not going to build the context as to what that would be. We'll have all kinds of opportunities to understand what that is in this series. So assuming that is the case, when your market breaks lower, okay, what in this price swing is your point of reference? Okay, if you're bearish, the overall price structure that you should be looking for obviously is individual price swings. Yes, okay, so in other words, this swing here traded up, whatever this range From here to here it's the retracement into. So there could be a selling opportunity here, but if you take the range between this high to this low, 127%, I'm sorry, 1.27 in the Fibonacci, or 127% of that, if you multiplied it, that would give you a lower objective here, and 162% of that range would give you the 162 extension down here as well. Same thing here. We have this high and this low, that range of pips. Once this low is violated, as it is here in this example, we could look at the range from this low to this high. Okay, we could see the 127 extension and the 162 extension as downside objectives. Okay, I should have said this in the previous mentioning, but the intermediate term swing between the smaller swings. Okay, think back in market structure now. This would be the higher level price swing, okay, or major reference point. The intermediate term reference points, many times if you see price take this leg here, if you project your Fibonacci based on that range, you'll get the 127 here and then the 162. Many times you'll get a intermediate term deeper retracement from the high that forms back here that's originally a sell-off. You'll get a retracement into that range, and then you'll see the fulfillment of this swing's targeting, which is 127, 162, which hopefully would arrive down here, in, conceptually speaking. But everything that I said on the bullish side, obviously, if you flip it, and you can get the converse idea for the bearish. Okay, and again, much in the same capacity, what we mentioned earlier. Everything that you see on price swings, if this is a move lower, you're looking for a selling opportunity here, this range, if you pull your fib from the low to this high, it'll project on your Fibonacci the 127 and 162 extensions. Down in that area is where you'd be looking to hunt about 75 to 80% of your exit points. If you feel absolutely certain, okay, that you're going to see a 200% extension, in other words, whatever this range is from high to low, if you're looking for a downswing, when this low is taken out, whatever that range is, it's duplicated, and you'll see that same magnitude wave lower, or swing lower rather, which is basically taking this low to this high, and if you had it in your Fibonacci's, it would be a 200% extension. But I'm trying to avoid conditioning you to expect that all the time. Okay, I'm conditioning you really to expect the 127 and 162 extensions, because they are very, very consistent, and you're pretty much going to be rewarded more consistently with that than you will get to 200%. And again, same thing. We have a premise that this is a bearish market move. We have a bearish impulse move lower. We have a retracement within that move. Something is implying a selling situation's underway. The range from this low to this high is used with your Fibonacci. So you use the fib from the low up to this high, and it's going to project your Fibonacci extension 127 and 162. Yeah, 162. And once it gets to those levels, many times you'll see a retracement unfold, and the impulse move lower here has a retracement, assuming that this low is significant in market structure. Something could be in line with another order block here within this range. Again, these are not just straight market moves. There's all smaller price swings within this leg in price, so you have to reference those as well, like we did in previous market videos in this series. When this range here is calculated, again, pulling a fib from the low up to the high, okay, it's going to give you 127 and 162 extensions, okay, on your Fibonacci tool, and that is where you would have your predetermined exit points. Couple examples real quick with the Fibonacci 127 and 162 extensions. We're looking at the fiber here. We mentioned this earlier in this video where the order blocks were. And just for a simple quick review, again, this is assuming that you understand this premise. We have this rally up, comes right back down to this order block right here. And again, framing the idea that this is bullish, so therefore when price returns back into this area, we could reasonably expect to see a rally up. And this is where we see our entry point right in here inside the optimal trade entry between the 62 and 79% retracement lows. And as price rallies up, okay, before we even see it go beyond this point here, what you're doing is you're looking for your upside objectives, okay? And because we're looking for upside objectives, you start with the high and you pull your fib down to the lowest low here, okay? And here's your 127 and your 162 extension, okay? And you can see that happened to be fulfilled. You get your 127 here, and not too much longer after that you get your 127 right there. Okay, and we have another order block here as price rallies up. You want to go borrow this level here. Okay, price rallies up, comes back down into the order block. Using the range, here's the low to the high. Your entry point is in here. Okay, and again, looking for upside objectives, you would reverse your fib from the high down to the low. Here's your 127 extension and your 162 up here. You can see it hits it right there. Okay, we have another order block. Right here, price rallies from this low up to this high. We're not going to draw the fib. In here, optimal trade entry. The high down to the low. Okay, here's your 127, hits it handsomely. And there's your 162 extension right there. Okay, so you have multiple examples on a pair that we have been utilizing for this series, but obviously it's applicable to any pair. Okay, and it wouldn't be fair unless we did some downside objectives, but I'm going to have to go to a different pair to do that. So let's take a look at the downside objectives utilizing the 127 and 162 extensions. Okay, we're looking at the Japanese yen, dollar versus the Japanese yen rather. Okay, we have a high, price trades down, retraces, and moves lower. As we anticipate a selling opportunity, and we're going to say for sake of argument that we suspected that price would be a selling opportunity in here. Okay, the way we get our downside objectives is to find the low up in the impulse move here, or retracement rather, from this range here. This is a retracement into the impulse move. We retrace, and then here's your 127, which it gaps through. Then here's your 162 extension. It trades just a little bit beyond that before it bounces again. Again, we are not advocating trying to trade outside of the 162 and 127. Use those as your guidelines. We have a price move lower, or impulse move lower. Then we have a retracement. Okay, again, same thing here. Assuming this is the range, high to low, optimal trade entry in here. You could be a seller here. Where would our objectives be? Well, here's that fulcrum point. Okay, Remember, this is the pivot point. When it breaks below that, we should see this move lower. Okay, the highest level would be 200% extension, or double the range from this low to this high, broken from this low here down. Okay, but sticking to the rules, okay, you're going to be utilizing this swing up, and you're going to be looking for the 127 and 162 extensions as your objectives lower. So if you're a seller here, you look to take profits at the 127 down here and the 162 down here. And scroll over here a little bit more. You can see this is where the price moved. It went down, let's see, from that price point to the low. It only moved 17 pips beyond what the 162 extension is. And then ultimately, price returned all the way back up to the area where you would have sold. So you can see if you were looking for a 200% extension down here, you would have gave up a really, really handsome opportunity to be covering your short and reversing. And just one more example on a short term, we have a impulse move here, retracement. Okay, find the low up to the high, the highest point right there, and your 127, and then your 162 extension, almost nailing the very low of the move. And then obviously you can see the price of the market moved higher. Okay, there are another opportunity of catching the upside here. You see this price move here. Okay, if you anticipate this as a buying opportunity, okay, this is your reference point on a price swing. Remember that first slide we talked about finding the upside objectives? Here is your fib. Pull it down to the low, and then here's your 127, and we just fell short of the 162 here, and we just might get that in the coming days, or it could be just coming up to fill this gap. We don't know, but on the upside, this could be a very favorable target for a very little short-term to intermediate-term trade on the yen. So hopefully it's been useful, and you guys can glean some insight from it.